Welcome back. You're watching Big Deal and we are discussing the equity market transactions in a volatile market. Now, Deepak, we spoke about the IPOs and the IPO pipeline. Now, last year, at the same time, some of the companies managed to go ahead with their IPOs with euphoric valuations and bumper listings. Now, they are all coming to the next milestone, which is an important part of their IPO journey, is the IPO lock-in period getting over for the pre-IPO investors. We saw a huge amount of pressure and impact on Zomato earlier. Now, Nykaa has happened this week. Paytm and Policybazaar, and Paytm in particular, will be a cause of worry going forward. How do you see this IPO lock-in period ending? Also, with now liquidity going away from the foreign market as well, how are the investors from the foreign markets poised in this particular period?
So I think yes, it's much talked about the lock-in coming off. There's a huge amount of paper to hit the market. Some have, like you said, in Zomato's case, obviously impacted the price. But I think we've had a phase where valuations have corrected, in line with how these sectors have performed globally. But if you think about it in the slightly shorter term, Nykaa actually today even, right, has held up very well, right? It's been very resilient.
They have been quite strategic, to say polite.
Yeah. But I think what we're seeing is there is sufficient demand. Now, I'm not saying there might be demand at this level, but these stocks will all find a level because they're all relatively good stocks in a space where where they're sort of differentiated, right? So, I think we will find a level. It's anyone's guess what that level could be, but just given the price action in recent weeks, we think that this price, the levels could not be too far away from here. And so that's an encouraging sign. Now, how are foreign investors thinking about this? Are you specifically asking about the lock-in period or the environment in general?
Environment, especially connected to the lock-in periods ending. So will they take the opportunity as soon as the lock-in period ends?
I think what we've found in the work and the inquiries that are coming from our foreign investors have been around this space. Now, they've all obviously had exposure to these kind of businesses in the markets that they are sort of domiciled in, the US investors and Asian investors. So they've done a lot of work. And for them, these are, either they've already come in the IPO stage and this is a way for them to sort of average down. But a lot of new investors have done a lot of work on these names with us. So we believe that appetite will actually be driven by some of these foreign investors as well. So that foreign money is there, and that's where the bid will come from.
All right.
But not to put away some of the domestics who are actually waiting for it to come to the right level. They're far more discerning and cautious on these names. But I think at a level, we've seen them come in as well.
All right. There I have to give it to the domestic institutional investors who actually had much more prudent approach to the investments than the foreign investors. All right. So, Rahul, you mentioned about Nykaa, and I was asking Deepak about the other two which are also lined up. From the sense that I got from what Deepak said is also that most of the negative news probably is baked in and the stock prices are substantially lower than their IPO price. What is your view on these companies, now Nykaa as well as Paytm, Policybazaar?
So, Nisha, if I can just on a lighter note, the famous Maruti commercial, which actually spoke about the economy of the car, and the tagline used to be "Kitna deti hai." I think the question is you have to ask what kind of returns at what acquisition price. And as you very rightly pointed out, I think most of these new age technology companies, whether they were in fintech or consumer tech, are down to anywhere between half to about a fifth of their 52-week highs. Let's take a look at Zomato, since you were discussing that with Deepak a little earlier. I think Zomato's high was about $190 or thereabouts, currently trading at about 60, give or take. Now, you're sitting in a quarter where you have a 2020 World Cup and then you have a FIFA World Cup to follow. So obviously the delivery business is going to do really well. Now, these are just case in point. So now the question is, do you invest in these companies as a trade, or do you view them as long-term investments? But I think if the trajectory of profitability is all right, which basically means is if a company has done 100 crores of losses in year A, If that number can come down by 15-20% and I have visibility of that, I'm okay if the losses are there, but they're coming down. But because the prices are at 1/4 or 1/5 of 52-week highs, it becomes a slightly more compelling investment argument. So this can probably be applied to across the board. It can, Nykaa is obviously probably more an urban or a tier 1 or a metro kind of a story. So if you're positive on, urban discretionary, I think Nykaa at the peak was about 24,000-25,000. So these are cases you can make. I think a lot of these are at interesting price points. Nykaa is an exception because I think it does make a profit and it has a marginal return on equity as well. But I think if you try to marry the fact that losses will come down, it's not going to require further private equity money to fund the losses, and the fact that they've come off substantially, they may not be bad trades or investment ideas.
All right, so quite compelling at these price points, and also, but I would think about the pre-IPO investors who invested at much higher valuations and may be under pressure to really cash out, because for the time being cash could be king and they may want to cash out. So that's one of the aspects to really watch out for.
Can I make a point there? You talk about the pre-IPO investors and the private equity investors who might want to cash out. Now, they've identified these companies very early on. They're sitting on, despite them, many of these have come off quite a long way. They're still sitting on very good returns. But our conversations with our private equity, clients, they've displayed a pretty good sense of responsibility around it. They want this to happen in an orderly fashion.
Right.
While they obviously want to time the market and get the best price out, I think they want to see it in an orderly manner, right? And continue to be sort of responsible partners to whichever companies they've invested in.
Yes.
Because they all own fairly significant stakes in these companies. So unless it's a full exit, they would want this to happen in the smoothest possible manner with the least impact.
That's a very important point, and that's what I was watching out for in Zomato as well, and that's where an investment banking advisory also comes into play to a large extent. And also the founders' relationship with the investor community is also very critical at this point. But let me jump to another important asset class that we have built over the years, and in an interest rate hardening scenario where capital is going to get expensive and equity market volatility may not give you that premium pricing. At that time, REITs and InvITs are coming handy for many capital intensive sectors. What is the action there?
Yeah, those two spaces are just absolutely going to roof it, I think. Like you were talking in the break, the space is ready to explode. We've had some good transactions over the last year or so. The people are understanding these products much better. The REITs, obviously, with anybody who wants a yield, but the growth pickup of equity,
yes,
that's a great sort of way to do it. On the InvIT side, it's really what has happened is, it's allowed us to segregate developer exposure and operator exposure, right? And that has been key because a lot of people in the past have lost their shirts, if you may, on taking developer exposure. So the InvITs allow you a fantastic vehicle.
Are you seeing a huge amount of interest? Because we have
yes,
unlisted also ones now, not publicly traded. There again, a lot of money can really come in.
Absolutely. And the InvITs is where we're seeing a lot of action. Our teams are working on 3 or 4 very large transactions at the moment. And we're seeing interest from across the board, And that's the other point. The depth of this market also has expanded, over the course of the last 2 years. So it's not just the big foreign sort of income funds. There are some domestic balanced funds that are coming in and are looking for it. There are family offices that want to...
And with the thrust on infrastructure development by the country. Rahul, very quickly, your end note on this particular space. How bullish are you on this? Because in an interest rate hardening scenario, in a volatile market, a safe investment with a fixed and equity combination, which REITs and InvITs present, could be a safer and a more cautious approach for many investors.
So I think, Nisha, the best way to look at it is it's an alternate investment class. So when you talk about alternate investment funds and a reasonable amount of exposure that goes into it, it's the markets in India are not that deep and penetrated or liquid on the non-equity side, which is debt. And the Reserve Bank of India and the government have been doing whatever they can. The good part, Nisha, is that especially on the InvIT side, the government of India itself is doing a lot of deals, whether it's gas pipelines, power transmissions, and a lot of others. I think a lot of road projects are coming through InvITs. And when you have the government of India, going down this route, it becomes that much more reassuring for the private sector to go down. As far as REITs are concerned, I think you and Deepak have summed it up very well, because you look at yield and, even as an equity investor, sometimes you look at dividend yield and free cash flow yields of companies. And a lot of these, sometimes if they can give you, like 8.5%, which I know are not fixed deposit rates right now, they become very, very good investments. So just take a look at the two largest REITs that are listed on the stock exchanges. Embassy, which owns assets like, Express Towers in South Bombay and a couple of very marquee properties in BKC, and Mindspace, which owns pretty much most of them in the Mulund area. So if you have leaders in the space where they have the bulk of the assets, I think you can look at it as a possible alternate investment class, because I know for a fact that a lot of AIF fund managers actually are looking at deploying a lot of incremental money down this route. So as Deepak rightly said, I think this is a space that's going to expand. It's going to get deeper. It's going to get more liquid. And it's a fantastic proxy to play the equity markets on in uncertain times.
Also, if I may add, not looking at it from the investor class, but from the point of view of the companies which have fewer options of getting cheaper funds or funds at this particular period, with capital getting expensive on the debt side and equity market maybe not giving that value, this could be a great way of really offloading the capital intensive projects which are already, commissioned, and then pump in the rest of the money and the bandwidth that the balance sheet has in building new projects as well. So that's one of the critical areas where REITs and InvITs can really play a very important point. Thank you so much for all the insights, and this discussion is going to continue on equity market deals. Thank you so much, Deepak, as well as Rahul, for joining us with your insights. With that, it's a wrap on Big Deal. Thanks so much.